I'm looking at the data coming in right now, and something about it does not fit the normal pattern markets usually follow. This is different. What we are seeing right now looks structurally disconnected, a widening gap between paper and physical markets. Let me walk you through what is unfolding because the numbers themselves are telling a story most people are not watching yet. Over the weekend, tokenized physical gold trading through crypto-based settlement rails moved dramatically higher in off-hour markets. Physical-backed gold tokens briefly approached the equivalent of $6,000 per troy ounce on thin but active trading venues. These are not futures contracts. These transactions represent claims tied directly to vaulted metal moving through blockchain settlement systems. Prices stabilized closer to the mid-5,000 range, still trading significantly above Friday's official Western spot close. A $100 divergence between physical link trading and paper reference pricing is not noise in commodity markets. It represents capital migrating toward channels where delivery confidence exists when institutional market control mechanisms temporarily pause. What matters here is not just the price level. It is where informed liquidity chooses to transact. This weekend did not unfold in isolation. The past 72 hours compressed geopolitical risk and energy logistics stress, and commodity supply concerns into a single accelerating timeline. Confirmed reports from Iranian state broadcasting indicated senior leadership figures were killed following coordinated airstrike operations, attributed to joint military action involving regional powers aligned with the United States and Israel. Iranian media described the deaths using official martyrdom language, signaling confirmation rather than rumor inside domestic communication channels. Any expectation that such an event might slow escalation proved incorrect almost immediately. Iran responded with one of the largest combined missile and drone operations recorded in recent regional conflict activity. Publicly available defense tracking data indicates more than 160 ballistic missiles launched alongside cruise missile deployments, and hundreds of drone systems. Interception systems neutralized many incoming threats, but multiple impacts were confirmed across civilian zones, producing casualties and infrastructure damage across parts of the Gulf region. More critically, Iranian military statements acknowledged targeting a United States carrier strike group operating in regional waters. Whether impacts occurred remains under verification, but the act itself represents a shift in escalation category. Targeting naval assets moves conflict dynamics beyond proxy confrontation into direct military signaling between state actors. Official rhetoric from Tehran stated that previous red lines no longer apply, while Israeli leadership publicly discussed regime-level objectives. Simultaneously, attacks linked to allied regional groups resumed along major shipping corridors including the Red Sea, expanding the operational theater across multiple maritime zones. While headlines focused on missiles and retaliation, another development unfolded quietly inside commodity infrastructure. And this is where markets begin to tell a deeper story. One of China's largest commodity exchanges issued a preemptive liquidity advisory before the trading week even began. The notice outlined procedures that could be activated if gold price movement depleted available liquidity pools beyond operational thresholds. Exchanges do not publish warnings like this casually. Such notices typically appear only when risk models detect the possibility of price acceleration, strong enough to overwhelm existing settlement capacity. Importantly, the concern referenced upward deviation scenarios rather than collapse conditions. Meanwhile, physical silver activity inside China's Shenzhen distribution network began showing behavior rarely seen in synchronized global markets. Reports from trading advisors connected to regional distributors indicated buyback premiums rising sharply, pushing effective physical silver pricing toward levels exceeding $120 per ounce equivalent. Even more telling than the price itself was participant behavior. Many distributors reportedly refused to sell inventory despite elevated offers. That reaction signals fear of future scarcity rather than speculative enthusiasm. When holders decline immediate profit because replacement supply appears uncertain, markets transition from trading environments into supply preservation mode. Across parallel platforms, silver prices diverged dramatically. Weekend digital spot markets traded near $100. Asian exchanges printed higher references above Western closing levels. Shanghai pricing maintained a sustained premium, while Western paper markets remained anchored near Friday's settlement around the low 90s per ounce equivalent. This creates a situation commodity professionals watch carefully. two markets pricing the same metal differently at the same time. Commodity pricing relies on a concept known as price discovery, the assumption that futures markets accurately represent the balance between buyers and sellers capable of exchanging real material. That system works only when paper contracts remain interchangeable with physical delivery. When physical buyers consistently pay substantially more than futures pricing implies, that assumption weakens. When holders refuse to sell even at elevated premiums, the linkage between paper valuation and physical availability begins to fracture. However, intellectual honesty requires acknowledging the opposing interpretation as well. Weekend markets operate with thinner liquidity. Tokenized metal platforms and regional exchanges process smaller transaction volumes compared with major Western futures markets. Under normal circumstances, arbitrage trading once large exchanges reopen can compress price gaps quickly. Historical precedent shows geopolitical fear premiums occasionally fading once institutional liquidity returns. Diplomatic intervention could still reduce military escalation. Insurance markets might stabilize. Futures traders may attempt to suppress opening volatility through coordinated positioning. All these outcomes remain possible. They represent the legitimate counterargument to a structural breakout thesis. But energy markets introduce another layer that cannot be ignored. Roughly 20% of global seaborne oil trade moves through the Strait of Hormuz, a critical maritime choke point. Current disruption is not driven solely by naval confrontation but by insurance economics, an often overlooked mechanism. It's capable of halting trade without sinking a single vessel. Commercial tankers rely on war risk insurance coverage. They need it to transit conflict zones. When risk pricing rises beyond profitable thresholds, ships stop moving voluntarily. Within 48 hours, attacks near the strait triggered a sharp increase in insurance costs for large oil carriers, jumping roughly 50% per voyage. Major shipping operators began suspending transit operations. Dozens of tankers reportedly anchored offshore, awaiting clarity rather than entering high-risk zones. The result is effectively frozen energy flow approaching 20 million barrels per day, alongside disruptions threatening liquefied natural gas exports critical to Asian energy security. Oil prices reacted immediately, rising sharply during weekend trading and holding gains rather than reversing. A signal that physical supply concerns, not speculative positioning alone, are influencing valuation. Strategically, recent strikes suggest infrastructure pressure rather than traditional naval confrontation. Ports, logistics hubs, and commercial handling facilities across multiple regional locations experience drone or missile targeting, demonstrating how modern asymmetric warfare can strain global trade networks without direct fleet engagements. Countries heavily dependent on Gulf energy routes, including Japan, South Korea, India, and China, now face varying degrees of exposure. Even diversified import systems cannot fully absorb prolonged disruption without price consequences. Beneath all geopolitical developments lies a longer-term factor already shaping precious metals markets. This was happening before any missiles launched this weekend. Silver supply has been running structural deficits, while industrial demand accelerates simultaneously across multiple technological sectors. Solar manufacturing, electric vehicles, advanced electronics, defense systems, AI infrastructure, telecommunications expansion, and nuclear energy deployment all require significant silver input. Mine production cannot expand rapidly due to permitting timelines and geological limits, and capital investment cycles measured in years rather than months. Lease rates for physical silver had already been rising. This was prior to the geopolitical escalation, indicating tightening availability within delivery networks. Gold accumulation by central banks also continued at historically elevated levels, reinforcing long-term demand pressure, independent of short-term crisis events. This distinction matters. Conflict can accelerate price movement, but underlying supply imbalance determines whether gains persist after headlines fade. As markets reopen, several signals will reveal whether weekend pricing represented temporary stress or deeper structural change. The size and durability of opening gaps in gold and silver futures will indicate institutional positioning. Persistent Asian premiums relative to Western pricing would strengthen the case for physical demand dominance. Energy insurance availability around Hormuz will determine whether oil disruption stabilizes or escalates into a broader supply crisis. Physical manufacturers purchasing metal for industrial processes cannot pause production while waiting for paper prices to adjust. Real-world demand operates on operational timelines, not trading strategies. That reality often becomes visible only when markets briefly lose synchronization, exactly the condition developing right now. Across the past few days, we have seen leadership strikes confirmed, large-scale missile exchanges, shipping insurance repricing global energy transit, hundreds of anchored tankers expanding metals premiums across Asian markets, and official exchange warnings regarding potential gold liquidity stress. Each data point stands independently. Together, they form a pattern worth watching closely as trading resumes. Because when physical markets continue operating while paper markets sleep, the prices revealed during that window sometimes show where risk capital believes true value exists, when intervention mechanisms temporarily disappear. And that leaves one question hanging as markets prepare to open again. If physical metal trades higher when unrestricted by traditional exchange hours, and if industrial buyers continue paying premiums to secure supply, then what exactly does the official paper price represent when trading resumes on Monday morning? The data speaks clearly. Interpretation belongs to the observer.